Warren Buffett's Berkshire Hathaway now holds a record $382 billion in cash, the highest ever on record in terms of the share of assets, and we also have members of Congress selling many stocks across the S&P 500, something that we always like to take a look at because they typically have some insider information that perhaps retail investors are not able to gather. And the big short investor Michael Burry is shorting AI with over $1 billion position, and even AI stocks themselves have been hit hard lately as bubble concerns grow, and with OpenAI striking billion-dollar deals left and right, the big question has now become, where is all of this money really coming from? Add in tariff uncertainty, where in fact it's looking like the US may have to refund all of the tariff revenue they've generated. We're talking trillions and trillions of dollars. And we've just heard today Trump saying that people that are against tariffs are fools, and more importantly that a dividend of at least $2,000 per person will be paid to everyone. Couple that with government shutdown fears which continue, we're seeing now the longest stretch on record, then it's no wonder that investor sentiment is sitting in extreme fear. But here's the thing, the markets are still flying. We're talking all-time highs. If we just look at over the last year, many companies are in fact performing very strongly. We're talking Broadcom up more than 100%, Nvidia, JP Morgan, Google, Amazon, Tesla, big names have performed very well. But in every period of fear like this, there are always rare opportunities. And that is why in today's video we're going to look at 6 high quality stocks that we're watching and the levels that they finally make sense to buy. But do bear in mind, in our view there aren't that many opportunities, because no matter which valuation metric we look at, all signals are flashing red, overvalued massively in fact in comparison to their averages and just in pure isolation. Whether we look at the forward P, whether we incorporate growth, so the PEG, whether we look at the price to book, price to sales, the conclusion still remains the same, and this is why the noise of an AI bubble continues to get louder and louder. If we just take a look, for example, Broadcom, which we just highlighted, is up 100% thereabouts in the last 12 months. The valuation on a forward P is sitting at 42. Not only is that the highest in the last 5 years, but look at their 5-year average at 19. Massive disparity, and in pure isolation, that does look incredibly high, no matter what growth numbers we are really talking about. In terms of yield as well, 0.7%, the lowest on offer to investors, historical average 2.5. And if we were to take a look at the blue tunnel, which as always for newer viewers highlights the intrinsic fair value, in fact Broadcom over the last 12 months hasn't once sat in the fair price. It's continued to trade at such a massive premium, one that's only been getting richer and richer during Liberation Day. Even that drop that we saw across the market, it still didn't even touch that, really highlighting how this company does look severely overvalued. And when we zoom out to the last 10 years, well look, it did for quite a long time trade around the intrinsic price, going as far back to 2016 to 2023. But since then, this is where we believe companies are getting a little bit out of hand. Valuations are stretched while fundamentals, yes, are strong. It is increasing over time, but the price isn't reflecting that. In fact, it is sitting at such a massive premium. Doesn't just apply to Broadcom. There are many companies. We'll give you one other, that's Costco. Yes, it's sitting at a forward P of 46. Just weeks ago, it was sitting above 50. So even with the drop it's facing, still in isolation, looks very high. Still above their 5-year average, which even 40 looks high for this company. But it just goes to show you, companies could come down a significant amount more and still look overpriced. That is a little bit worrisome. And you can also note when we look at the blue tunnel for Costco, likewise with Broadcom, over the last year, not once has it traded at its fair price, but you'll notice it is a little bit nearer to the upper end of the fair value. And when we zoom out to the last 10 years, well, you only have to go back to around the end of 2023 to see it in a fair value range. So what we're really trying to say, many companies are trading at levels that even with another 10-20% drop will still be looking overvalued. but there are some that we've identified that are high quality and are on the watch list. Now we'll kick off with maybe the most obvious one today, Meta Platforms, which is up 5% in the last year. Year to date is also up, but massively underperformed the S&P, 6%. Over the last 10, this one has seen a lot of outperformance, up 500, one that we've covered in depth. It is only a little bit of a quick recap with the updated valuation given the price drop, but it's now trading around the mid to lower end of the 52-week range. A strong buy from Wall Street, 4.55 out of 5. Seek Alpha, it does have a buy rating, but on the weaker end of 3.9 out of 5. And unlike the likes of Costco and Broadcom, we're noticing the forward P in isolation, 21, very attractive, but also below the average of 23.2. This is what we would say, unlike those two, a potentially undervalued play, and that is also confirmed when we take a look at the blue tunnel. It is sitting just below the bottom end, something noted during the Liberation Day drop. But also look at the disparity, even when it does sit above the fair price, we're not talking as high as the likes of Broadcom. So even with a drop around 10%, this would put this into a severely undervalued play. With the likes of Costco and Broadcom, even a 10% drop would still put it either an overvalued or potentially a reasonable signal. But zooming out to the last 10 years, unlike those companies, Meta Platforms is one that has historically been trading at a discount for quite some time. So if you do believe history doesn't repeat but does in fact rhyme, maybe we will see this very soon in a severely undervalued signal. And the other thing we want to point out is on a valuation basis, yes, a D- as they are trading at a massive premium to the sector of 15, in fact 60%, but there will be a lot of poor quality companies sat within this bracket. The takeaway we want to draw right now is on a price to earnings growth 1.5. That is very attractive. Not many companies in the S&P are trading at a PG, in fact below 2, and this is where we would typically look to take a bit of a deeper dive. However, the only caveat we would say with Meta Platforms is that historically over the last 5 years, this is where the PG has been at 1.55. Now our intrinsic price gets to $798 updated for their latest quarter based on the discounted cash flow valuation. You'll see over the last 10 years they've been growing free cash flow 34% year on year, most recent year at 23%. Moving forwards, we want to be conservative at 12%, and inconsistent with what we normally do, we have used the lower rate today of 12%. You'll notice 12, 14, 16. As always, numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, Meta Platforms, or any others. Key takeaway you may say is on a reverse DCF baked in if you're buying around 621 is 8.5% growth to the future free cash flow. If you look at that and say, you know what, that is really high, then already you could say potential overvaluation if you believe it'll grow at a much faster rate than undervalued. So 12% with the discount rate gives us the present value of the future free cash flow terminal price. Add to go with the cash, subtract total debt, get the equity value, divide by the shares outstanding, 798, indicating 29% upside. You may say, no, that is way too conservative. Well, at 14, the medium rate, which we typically use, 919, 48% upside. And if you're even more bullish, look, 16%, $1058, 70% upside. Now we're not done, and we do want to use the lower growth rate today of 12% because we want to understand what is the margin of safety that is in fact on offer, and we typically use 10% execute on that buy if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. Well, look, in fact, you're getting more than 10%. We're already seeing this flash 22.2% MOS today if you believe 12% growth is in fact reasonable. And for those that do want to see it 25, well, a buy around the $600 mark. Wall Street themselves, even with lots of different price targets, on average $840, 35% upside into next year. Maybe Meta Platforms is one that you believe is a strong buy right now, but the numbers do in fact look very good. If you want to use the middle rate of 14%, which is what we typically do, well, MOS even more attractive, 33%. This would mean a very strong buy, and will show for completeness at 16% if you do believe that is where this company will be heading in terms of growth, 41%. So regardless, upside looking very attractive across the board, and even on the lower growth rate for Meta Platforms today, you're getting a 22% margin of safety. So let us know your views on stock number 1. And before we continue, we want to let you know we have just today released our latest free weekly article covering 3 stocks to buy after the market pullback. As always, we deliver one every single Sunday morning to your inbox completely for free, looking at severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of November, lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're looking at is Adobe, battered 35% in the last year, year to date down 26%. Over the last 10 though, still managed to outperform the S&P, up 267%. We will make you aware though, all-time highs just under $700, going back now around 4 years ago. And if we take a look, it's pretty much trading at its 52-week low. Its 52-week high sits quite above $558, where both Seeking Alpha and Wall Street give this a buy around the 4 out of 5 region. And on many of their valuation metrics, they're trading not only at a very attractive level, but actually at historic lows. If you want to see the EV to EBIT sitting at 16.9, we're talking just a few years ago, this was around the 68 region. And even on the other valuation metrics, it's looking attractive. It does get a C+, but look, given the forward P around 15 to 16, that is a 35% discount to the sector, 50% discount to their 5-year, but price to earnings growth 1.1, that is at a 38% discount to the sector and 44% discount to their 5-year that sits around the 2 region. You're now seeing this at 1.1. That is very, very attractive, although that really is if you don't believe AI will disrupt this company at a very fast rate. That is really where the bearish scenario stands, and many investors probably don't like this company and have already moved on to look at stock number 3. But our valuation sits at just below $600, again from the DCF model, where we've used a growth rate of 8%. Baked into Adobe right now at 52-week lows is negative 1.6%. That is a decrease over the longer term to their future free cash flows of 1.6%. Using the middle growth rate under $600 is 83% upside. You want to be very conservative at 4, which we do believe is unreasonable. We think it can be a lot higher. Well, look, 465, that is 42% upside, and at 12%, which we do believe is still reasonable, something they can achieve, but maybe at the upper end, hence why we have it at high. 765, more than double, 134%. Now, using the middle rate today of 8%, you're getting a very, very large margin of safety of 45%. Wall Street themselves see 453 into next year. That is 39% upside. They're clearly very bullish on the company. They have a buy rating 4 out of 5. So maybe one to consider, again, if you don't believe AI is going to be a massive disruptor. Not something we're seeing in the numbers just yet. They raised their guidance in the latest earnings, double-digit revenue growth. And if you do want to be more conservative, well, look, at 4%, you're still getting an incredibly attractive MOS around 30%, and it isn't too far from where Wall Street see this into the next year. So let us know, stock number 2, Adobe, whether you see it maybe as a buy, hold, or complete avoid. We then move on to stock 3, Mercado Libre, up 19% in the last year, up 24% year to date. Over the last 10, up nearly 1,700%, trading around the mid to low end of the 52-week range. Respectable buy from Seeking Alpha at 4.2 out of 5. Strong buy from Wall Street at 4.6. And it's the only public company in the world out of more than 83,000 companies to grow more than 22 consecutive quarters in a row at a yearly rate greater than 30%. They're currently sitting at 27 quarters. Such an amazing feat for Melly. And we can also see their free cash flow over the last 9 to 10 years has been growing at 61% year on year. Margins also looking very impressive, upward trend, sitting around 34% in 2024. And yes, valuation grade is at a D- if you want to look solely at a forward PE, 218% premium to the sector. But the takeaway here is price earnings growth 1.6. That is in fact a little bit below the sector median, and even in isolation does look very attractive. Now, our intrinsic value, $3,318, is using the middle growth rate of 6%, baked in today if you're buying Mercado Libre, essentially saying there'll be no growth to their free cash flow over the longer term. Really, again, lots of opportunity if you believe in this company, if you want to perhaps look outside of the US, and 6% does in fact lead to 57% upside. If you want to be incredibly conservative at 2%, well look, $2,459, 17% upside, and we wouldn't even say 10% is unreasonable, $4,454, more than a double at 111%. Now, using that middle rate of 6%, you're getting a whopping 36% margin of safety. Wall Street, very bullish. We saw the strong buy rating, 2950 into next year, 40% upside. Mercado Libre, maybe one you've got your eye on, maybe one you're a shareholder, or one you want to completely avoid. And even at the 2%, you can clearly see margin of safety for consideration at 14.2%. If you believe you want to look at that rate, well, at 20%, just under $2,000. So let us know your views on Melly today. And then we move on to Netflix, a company that does look on the richer side in terms of valuation, up 39% in the last year, 24% year to date. Over the last 10 years, up just under 1,000% on quite a large pullback from its 52-week high of $1,340, sitting somewhere around the midpoint of the 52-week range. Double hold from Seeking Alpha and Quant, although Wall Street do give it a buy at 4.14, and they've been doing something we love to see, which is increasing their free cash flow over the last few years. Granted, they did have many years where it did sit negative, and just in their latest quarter, they saw their top line up 17%, the largest growth being from Asia Pacific, up 21% year on year. And as always, high quality companies will do two things. Yes, every company can increase their revenue. That is what we see across the S&P, but not every company can show efficiencies, increases to their margins, gross operating, something we're seeing from Netflix over the longer term. And on a valuation perspective, they do get an F. Again, very similar to other companies. Forward P does look high, 44, 193% premium to the sector. Not too dissimilar from their 5-year average, but price to earnings growth, 1.8. That is in fact attractive in isolation, but actually above both the sector and their 5-year average. We're talking about a 20% premium. But look, this is a growth company. They have an A- year on year, up 15%, projected there or thereabouts over the next 12, well above the low single digit of the sector. They're actually something that is fairly rare to see, growing slightly faster than they have done over the last 5 years, and they're projected to grow their earnings per share at 24% year on year over the next 3 to 5, well above the sector at 10%, but also just marginally below their 5-year of 27. Now, our intrinsic value gets to $832, where in fact we have used a growth rate of 15%, and you'll see, unlike the previous companies, a little bit on the higher end in terms of the reverse DCF at 19.5. So you already know for Netflix, unlike the previous companies, we would want to see a larger drop before getting interested, because if you use a growth rate of 10 or 15%, we're talking double digit downside, 20% around 3%, and 25 at around 39. So using the 15%, which we've classified as the medium rate today, you're actually seeing a 33% premium. There is no margin of safety. At a 10% MOS, if you believe that rate to be reasonable, a buy at 749, at 20 a buy at 665, and at 25 $624. Now, Wall Street disagree with us. They see 1,400 over the next year. That is 27% upside. But if you do want to look at the higher end, or that is what we've classified as at 20%, what you will notice is, in fact, this is sitting above the market value. So you're getting a margin of safety sitting around 3%. And if you believe, in fact, they can grow their free cash flow at 25%, well, we're talking about a 28% margin of safety. And you can see they're projecting EPS to grow around 24 over the next 3 to 5 years. So it really does come down to your own overall expectations of growth. So let us know whether you see Netflix right now as a buy, maybe one as a hold, or a complete avoid, or like we're saying on the watch list, if it does drop low, if we get a lot more weakness, one to pick up at the dip. We then move on to ServiceNow, down 15% over the last year, 19% year to date. over the last 10, up nearly 1,000%, trading towards the lower end of the 52-week range. Double hold again, seeking alpha and quant, but a strong buy from Wall Street. And this is one company that has a very, very beautiful revenue growth graph. They've been growing their revenue 30% year on year, going back all the way to the last 10. And again, F1 valuation, forward P around 50, 107% premium to the sector, 29% discount though to their 5-year. Price to earnings growth, the highest we've seen so far today, but sitting around the 2 region. 13% premium to the sector, but actually a little 8% discount to their 5-year average. And our intrinsic price at around $1,100 is using a growth rate of 20%. Baked in sits at 16.5, and if you do use that moving forwards, we're talking about a 21% margin of safety. Wall Street actually see the price a little bit higher than our fair value over the next year. They're looking at 35% upside, but if you do want to be more conservative, bear in mind at the 15% growth rate, you will notice you're paying today an 11% premium. Again, for completeness, we will show you at the higher end of 25%. Bearing in mind, just look at their growth. We are talking very, very strong over the last few years. This is a company where the free cash flow growth hasn't started to slow down dramatically. So 25% we can see 1518, 43% MOS. Again, will really depend at where you see it, but at the middle rate for ServiceNow at 20%, we see a 21% margin of safety. Wall Street 35% upside. And then we get to Uber, which is up 26% over the last year, 53% year to date, trading towards the upper end of the 52-week range. A weak buy from Seeking Alpha, a strong buy from Quant. Wall Street very near the 4.5 to flip them into the strong buy rating. And their latest earning was also very impressive, 20% growth on their top line, largest driver in fact coming from Uber Eats delivery, where it was up 29% year on year. Their trips were up 22%, their monthly active users up 17%, gross bookings also looking strong with 21% growth, and we also get to see their free cash flow growing at a very, very attractive rate. It is moving in the right direction after being negative for many years, and monthly active customers also trending in the right direction, up 27% year on year going back to 2020. Now valuation at a C-, forward PE sitting at 16, that is a 23% discount to the sector against their own 5-year average, a 55% discount. But look at the price to earnings growth, 0.56, the best one we have seen today against the sector, a massive 70% discount. And our intrinsic value just below $150 using a 15% growth rate. Well, look at that, 8.2% is baked in today, and using our middle rate, you'll see in fact a 38% margin of safety. Now, Wall Street don't see it as high in the next year, $117, that is 27% upside. But if you do even want to be on the more conservative side of 10% growth, well, just take a look, you're still getting an MOS of 12%. If you believe though 10% is reasonable and want 20%, a buy at around $84, and at 25, 78. So let us know your views on Uber today. Is it a buy, hold, watch list, or maybe one to completely avoid? And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us in the Patreon where we cover our buys and sells. And as always, have a great day. We'll see you all on the next one.